Quite an eventful day today with these big tech CEOs testifying in Congress, as well as our Fed decision and Fed press conference that the market seemed to like. But despite that, still a very, very small, quiet day in context of what we have coming up later this week. So I'm going to break down today's move and with that in mind and what we expect to see going into a big Thursday night, right, where all these pretty much they've all lined up together to announce their earnings all at the same time, as well as some other stocks too. They're kind of flying under the radar, but it's going to be a pretty busy next couple of days in terms of earnings announcement. So I'm going to break down our technical outlook from that perspective, as well as start to build this hypothesis of how we may behave over the next month or two as we head into the end of the summer, and then we head into September and October, which can be relatively volatile months. So we're going to take a look at what that's going to look like. With our trade idea of the day, we're going to take a look at a stock that had a little bit of a breakout and see how we might trade that with this market posture in mind. So let's go ahead and get started. Today is Wednesday, July the 29th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. We continue to come higher here with short-term sentiment now getting into the upper half of the market forecast. Still got a strong intermediate posture, still above its market sentiment. Its market sentiment still working its way to that 80th percentile, which again sets up, for clusters with all four lines, if and when that ever happens. Very different than when you get the clusters and the intermediate line terms up, like something like this. It came really close to an overbought cluster. Those overbought clusters that occur like right here, they're very bullish. The more we get them down over here, not months into this, not so bullish. In today's class, our trading room today, I outlined how things may look here going forward as our rate of change is really at a high level for the S&P. It's still at 10%, almost 11%. But you notice working our way down towards zero. So very similar to when we came off of this move. Now, how is it going to look as we get down to zero? And we worked out a couple scenarios, which one I thought was most likely, which one I preferred. And we broke that down. So again, check that out for a lot more detailed analysis on how I think we could look heading into about the September the 13th. I think we're looking at September the 8th, September the 13th, in that time frame. That would be like a 5-month long intermediate run if depending upon how it ends up looking, but whether we get our intermediate pullback before then or not. But as of right now, there's no imminent signs of an intermediate pullback of the intermediate line dropping down below the 23% level. On the S&P, you can see it was closer on some of these others, especially the NASDAQ. The NASDAQ 100, we actually got down to the moving average, but unlike the S&P, where the moving average is actually pretty high in the between the 0 and 23% area, the NASDAQ, the moving average was just getting above the 23% because we had moved up that 0 so high. So it's we're just now getting there, but that moving average is moving up pretty quick. So again, to kind of give you an idea of what kind of drop it would take just to the 23% line, which remember is not a pullback, it's just noise. Anything between 0 and 23 is just noise. The only reason why this gap is so big is it's not normally this big. The only reason why the gap is so big is because the move has been so big. Right? Normally, if you notice, if I were over say in this area, you see not very big of a gap between 0 and 23%. You can get down there very easily. So when I say that it's just noise, some of you might be thinking, well, that's a big drop. How can that just be noise? Well, it's because the gap is so big, and the gap is so big because the rally is so big. So everything's got to be put in context of this rally. A 5% drop right now would be nothing because that's nothing compared to this rally. A 10% drop would be nothing because of this rally. So a 10% drop over here would be something, but not over here because the moves going into it is different. And that's just kind of the nature of the beast, so to speak. But you can see if we were to drop to the 23% line, which is sitting at 10,055.09, and you can see the moving average tomorrow, as of right now, the moving average tomorrow is at 442.55, looking up there at the top, this green number right there. So 10, it's actually right here now, so right over in this area. So it'd be 10, 442, 55. That's where it's going to be tomorrow if we keep on the same pace. So that puts it at, let's see, so divided by 10, 442, what was it, 55? So that's a 3.7% drop below the 30-day moving average if we were to get down there, especially if we were to close down there. To kind of give you an idea of what it's looking like on the S&P, which, you know, it's really taken off too. So the 23% line here, let me add on, let me add those numbers on. Just throw it over here on the left. So we're looking at 30, 22, 68. Versus where the moving average will be tomorrow at 3164.09. That is a 4.5% drop. Again, just to the 23% retracement, which would just be noise. But that big of a drop below the moving average has shown in the past to be, you know, if it doesn't, you know, you can see that big drop here, over here on the far left. You know, if it doesn't keep going down, like I showed you a previous pattern, a couple of years on the 2-year chart right here. So we dropped really far, and then we, you know, that was also just to the 23% line, and then we fell down eventually to the 38% line. So, you know, even if we do that, or even if we just do this, where we just drop really sharply and then just stay down while we get dark pink shading and red lines, you know, that's, by the time we break, the next time we hit the 23% line on the S&P will most likely be our intermediate pullback. Now, and that, you know, again, that would just be noise. So I would expect at some point we could go down even below that. But also keep in mind, if we were to really take off from here, depending upon how far up we go, you can see we can pull the 23% line back above the 30-day moving average and not be such a big deal. So, you know, keep that in mind. It kind of depends upon how fast we go up here. If we keep grinding higher and the moving average keeps catching up to where we are without us moving things very much, then you can see how that type of move. And again, if we were to do that right now, that would be our it wouldn't be the intermediate pullback as soon as we got there, but we would get one by the time we're done with this, by the time we're done with that exhales, because of how far below the moving average it would be, just to get to that point. And I would expect we'll probably get down closer to where the 62% level is. You can see from the Bollinger Bands, there's the 62% line. You can see just above that line. So there, the point of control in the 1-year chart's at the 23% line. If we were to break that, you know, you've got a volume node sitting right on the 62% line now, and then the 38% of the rally, so this one right here, is sitting at the bottom of this volume cluster here. This big series, including the point of control and that node, this big series of nodes. That's kind of the bottom. They start to really taper off from that point, from where the 38% level. So there's some very strong levels of support all the way down here. So as we do fall down, and the market will make a big deal of it, and it's not going to be that big of a deal because it's not going to go down very far, and we'll find some very good levels of support that will help us go back up. But not right now. Like you can see now, we're back up to the 81st percentile of the bandwidth. So, you know, we've got a pretty decent bullish pattern going on here, including some of these other oscillators getting back up above 60, you know, among other things. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, hit that thumbs up icon that's down there. That tells us two things. Number one, you liked our video today, and number two, you want us to do another video. If you like our videos and you want us to keep doing them, let us know. You can do it right now with one click. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What questions or comments do you have about anything I talked about in the video tonight? Post those down in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on YouTube, or on our website, excuse me, you can also check out some of these other things. Again, if this Market Outlook Live, if you click on that, that takes you to our Market Outlook Live page, where you can see me. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. and I look at today's trade idea, or all the old trades ideas that we've done, we continue to manage them. We also put on today's trade idea already before the market closes. So that kind of gives you an idea of what we're going to do. All of our old archives right here, if you click on this menu, you can see all the old archives that we have for all of our live videos. So again, all of our monthly subscribers get access to that. They also get access to all of our classes, including all the recordings. You can see how many we do a week. Those are all posted right here under Trading Rooms. The Market Outlook Live is also posted right there. All of our monthly subscribers, our Plus subscribers, get access to that right here. Our Premium subscribers get access to things like all of our charts, all of our custom charts that we have, as well as trading plans, other premium tools and content, as well as access to our forums, including all of our class forums that we have, where we create, we continue our discussions in our classes throughout the week. All right, let's get back to our long-term charts, our charts here. And let's take a look at the long-term chart for the S&P. You know, again, not a higher high yet, but we are getting a higher close, no lower shadow. It's a very small body, so it makes the lower shadow a lot easier to occur. So this is something to keep in mind, especially with the real significant transition candles we're getting on the NASDAQ, right? So in a really, really small range and small body. Of course, that's going to change on Friday after all these big mega cap tech names report after the market on Thursday. So we'll get in probably a really quiet day tomorrow, and then Friday you'll see a significant jump there to the upside. So, but we are well above the 50-day moving average. You can see where the 200-day moving average, way down there. The 50-day moving average now is moving above the 23% retracement. But you know, this again, like the Dow, and look how small these ranges are. The Russell is the only one that really kind of looks like the S&P, and you continue to see how close we're getting to a cluster there, or a golden cross that we finally got on the Dow, that we got a long time ago on the NASDAQ. And then the S&P so many weeks ago. So we've been pretty bullish. You know, again, look at the 200-day moving average. This would be the 40-week exponential moving average. If I were to move this up, activate this, and move this up again, this is one big long intermediate run, right? You can see the 40-week moving average has now moved above the 23% retracement. So by the time we break the 23% retracement level, not only will be, by the time we hit the 23% retracement level, not only will we be well below the 30-day moving average, but we will also be below the 200-day moving average. And that will just be a 23% retracement, which is, again, just noise. So that's how much we've moved up and how wide this gap has gotten, and how much we've kind of gone here, even on a slow grind, without necessarily dropping and getting an intermediate pullback yet. You take a look at, here we are on the 3 green arrow chart, and you can see the bounce back above the 8-day moving average that we got here today. So we're kind of going up and down through the 8-day, but at least so far we're holding the 17. But the MACD is below its moving average. The stochastics is below its moving average. The Qs have been even worse. The MACD has been below its moving average this entire time, and so has the stochastics for most of this time. We did drop below the 17-day only to bounce right back up, got back below it again, bounced right back up. The gap is shrinking, so you know, just kind of keep your eyes on any kind of breakdown below the 17 that stays down, because especially if that's what happens on Friday. Otherwise, if we get back up and we pull back away from the 8-day, then you'll see this MACD turn back up, get above its moving average. Might not get as high as some of these other levels, but you know, we'll turn back up and at least stay up in this area here as we continue to grind higher towards that September time frame. All right, let's take a look at the intraday chart here. You know, see that we still don't have that 4-week rate, that 4-week new high yet. So we kind of need to start pushing that up, because the 4-week low is going to really be pushing up really rapidly here. So again, after the end of the week, the 4-week low point is going to be right there. So you know, that's going to be a pretty tight range, at least as tight as it's been. Like, you know, from around 310, you know, about what, 16, 17 points, it's about a 5% range. normally that's actually the extent of a bullish move, but considering how bullish we've been, that's about as tight of a range that we've had in a long, long time in the 4-week range. And of course, if we don't, after another week, well, actually probably take another couple of weeks, we'll be moving the low point up even further up into this area. So that's how much we've gone sideways. I mean, we've gone side. In fact, the Arun indicator can kind of give you an idea of just how sideways we've been. Right, when we are as sideways, when you go on a 4-week level as sideways as we've been, eventually this green line will start moving down, and if the red line's still down too, so that means the high and the low are on this side of the chart. That's when things have been so sideways, we might get a little bearish at that point. So to kind of give you an idea of what that looks like here, that's the low tag is already over here, but if the high tag gets over here too, while the low tag is over here, because we don't, like eventually the low tag is going to be right there, right? And the low tag then after that will be right there. So if the high tag stays here and then they both move in that direction to the left, that's when the Arun indicator, that's when things can get pretty bearish. You would expect, again, after a big long bullish move, you expect a breakout to the downside. So we can just kind of keep our eyes on that high tag pushing up in the next day or two to maintain the bullishness. That's actually what I expect we'll see. I don't expect we'll get huge big bullish moves, but enough to get at least slightly higher highs as we work our way up towards 330 and maybe a little bit beyond that. 330 there. That was actually a key level for for our class today, kind of a little bit beyond that 330 area. All right, so, but if you look at today's range and the volume still very, very light. It has been light for the past few days. Another day of 48 million shares trading hands, another day of really, really small ranges. So not surprising because of what we got at the end of the week, and no one really wants to make big moves before the end of the week. So what we have is this is really falling down pretty sharply. Now remember, this is a relatively high level normally for the ATR relative to price, but it's starting to fall down. The volume, if you take a look, just for some context in this, the volume is almost back down to where we were at really strong bullish levels. This is the average volume, mind you. The ATR still got some room to go to get down to these. Remember, 1% is 3.25 points, and we're still at 4.77, so that's why this is still kind of up and beyond. But once you get below that 1% and the volatility stays down, you can see it's extremely low. One of the lowest closes, if not the lowest close that we've had on volatility in a long time. Right? See, none of these. This one we closed at 24.32. Today we closed at 24.10. So very, very low closes and very small ranges. And we'll probably get another small range tomorrow because no one's going to want to do anything big tomorrow ahead of tomorrow night. Right? So you look at 3 points range on volatility, 2.39, and then yesterday 1.8, and today 1.69. And again, tomorrow's range you would expect to be pretty small. So when you look at the ratio here, and let's change this to a 3-day RS ATR. Give me 1 second. There we go. And then let's move this one to a 3-day as well. Then let's pull up the VIX here. You can see now how, okay, we're really dropping, and that's one of the lowest levels that we've had on the ATR here. This is one of the lowest levels that we had. Over here we had, it got down to 2 points was the average. We're at 2.17. We're probably, depending upon what happens tomorrow, we'll probably have about a 2-point range tomorrow too. So we'll probably get to that 2 point, if not lower. And again, that preceded a relatively big jump in volatility up to the 40s from what was a low close there of 24.5. So, we're really, really grinding again. If you look at it relative to where the VIX is, see, this was 2 points relative to 24.5. Now we're at 2.17 relative to 24. So we're actually still relatively high, but we are below the 10% mark. Just kind of give you an idea of how significant that is, the 10% mark. Let me put this on because this is relative. This goes back, this is apples to apples. You can see when you're below 10%, you're pretty bullish, but you're also pretty oversold on volatility. when you're, at these higher levels, when you have these big jumps in volatility. This is the fourth quarter of 2018. When the 3-day VIX gets down to that 10% mark, that tends to be the bounces. We saw that over here. We saw that again over here. And as of right now, we're seeing that again here. We'll see if that leads to a big bounce again, or if we eventually just, because at some point in time, we are going to break. We're going to break, this 1% level here, break the 20 mark on the VIX, and then we're going to be entrenched in a bullish mode. I don't think that happens, though, without an exhale first, right? An intermediate pullback down, and I'm less and less thinking we're going to even get to the 38. And most likely we'll tease below the 23% because that's going to be far enough. But we'll probably tease below that down to this old 62% line. There's some pretty significant support in this area. So that's probably about as far as we'll get if you look at it on the Bollinger Bands. And then not just the 1 year, but let's look at the 2 year. Let me get rid of the probability cone so we can see it a little bit better. So here's the 2 year, and you can see where the 62% line is, and for that matter, the 38. That's over the last 2 years, including some of this area here, and all the way back to 2018. There's a lot of volume in this area. So there's going to be a tremendous amount of support when we hit that. So we might not get to the 38% line. That might be all we get down to is the 23 and a little bit below it, and that's it. So a little bit below 300 just to tantalize the people that look at those big round numbers and think, oh, we broke 300, we're going down. It's like, nope, we're not going to go down. We're going down a few points as a sucker you in, and we're going to go right back up. More than likely, we're going to go right back up. That's kind of the, my expectation there. If we end up, and once we finally get our intermediate pullback, of course, if we continue to move higher, if we go too much higher, you can see that's where the 38% retracement is going to hit right on that point of control. Right, so you can see if we get up to these old highs, that's where your 38% line is going to be. So that would be an intermediate pullback by definition. At that point, we would be well below the 23% line, well below the 200-day moving average for that matter, if we were to do that. All right, so before we move on here, just to summarize the technical outlook, we're strongly bullish. There is an idea that we can continue to grind higher. There's a pathway that's set out there. There's a pathway for, kind of a, what we expect to see going into September expiration. That's most likely going to occur. It might not be the best case scenario for us, to have a 5-month-long intermediate run. In fact, it's never been the best case scenario for us to have a 5-month-long intermediate run. But it's seemingly more and more likely we'll get something like that. By the time we get there, before we get September and October volatility, which we've seen in the past, and will be amplified this year with opening of schools, new football season starting, any kind of coronavirus effects that may have, as well as the presidential election, which will probably be more uncertain than normal when you have an incumbent in office. So a lot of uncertainty in those 2 months, which are already more volatile than normal anyway. And so probably until then, we can expect to see kind of a slow bullish grind higher before that volatility increase starts. So what do you think? That might not be without short-term volatility jumps in between now and then that would coincide with maybe near-term pullbacks before we finally get this anticipated intermediate pullback that ends this great intermediate run that we've been on since those March lows. So what do you think? Do you agree with that? Do you disagree? Comment down below in the comment section, especially if you disagree. Love to see what you're seeing that suggests why you might be a lot more bullish than I am, or why you might be a lot more bearish than I am. What charts, what indicators you're using, what economic indicators you see that's out there, and share that with our community down below. All right, now let's take a look at what's driving this price action. And we still have the main driver. And the main driver of this price action continues to be the US dollar. And it had a big jump up today. Second day this week, we had a big jump up. In fact, you see this little black line. If I were to zoom this out, in fact, let me go out quite a bit. You can see, and let me go to a weekly chart here. You can see this blue line coming down. I'm trying to best fit these highs as best as I can. Depending upon how you draw that line, we're getting a pretty decent breakout with a new intermediate posture, right? The intermediate line's dark green, the dark green shading, excuse me, the green line, the moving average is green. The intermediate line just barely got above 80. So, depending upon, are we getting this type of move like we got in '06 where that was kind of the end of the bullish market that peaked. Remember, the bullish market peaked here in October of 2007. That's where it peaked, was right there. So by the time the stock market peaked, and, you had this good run through 04, 05, 06, and then we peaked in '07. There was a little bit longer of a run because that's, commodity inflation lags, commodities lag. So the dollar continued to fall even after the market started to roll over. But by May of 2008, that's where we failed at the 200-day moving average, and the bear market really started kicking in gear. And at that point, the dollar's been really bullish ever since. It's been on a downward trend. It's got its periods of bullishness or bearishness where the dollar fell, but ever since then, it's been the dollar's been really bullish until this last little period, and now it looks like we're turning back around again, and we're making that kind of run, to the upside. We're coming up off, one of the higher lows, a higher low than we had here, and we're, breaking the trend line, which we hadn't done initially. Now the question is, are we going to break the trend line and stay there? Right? That's obviously the big question mark. I mean, you look at it from a weekly standpoint on some of these other charts. Like the euro, obviously we're getting a very strong daily trend here, but if you look at it on a weekly time frame, here we go, it's just getting started, right? We're just barely getting above 2.5. We're just barely getting above 60 this week, and you can see we're just getting to that 62% retracement. So you break through there, we can really get going. That's the last resistance level here for the dollar, which may mean, might mean that we get that intermediate pullback. Again, any intermediate pullback, you're going to get a pullback in the euro, more than likely. The dollar will go back up from this oversold condition it has. So just kind of keep that eye. And, if it's going to occur now, it's going to occur there. If not, if we're going to continue through to September, then you'll probably see this break through up to the 78% before we pull back down to 118. Let me give you some perspective on this too, like that same perspective on that 2006 time frame. So right here, where it really took off in 2006. Excuse me. Sorry, something stuck in my throat there. So we got through the cloud, and then we started to get some trend going here, and that's kind of what we had already earlier this year after the COVID. Got through the cloud, but then once it got going, you can see the bullish trend, this trend strength. Got really strong and stayed really strong for a long time. 5 is right here. So once we got up to 5, there was another period there in '02 up to '03 where the euro really took off there at the end of that bear recession that we had. So you can see the big long bullish runs it can have, and if we're going to have a big long bullish run, we are just getting going according to this indicator. And then of course, when you look at the Bollinger Bands here, you can see that how wide. Oh, excuse me, that's the S&P. You can see how we're kind of getting going there, and let me give you some perspective on that on the Bollinger Bandwidth. There's that '06, '07 period. You can see how we're pushing that upper band up. We're pretty high right now at that 10% mark. But we can get up into that 15 to 20% mark, as we've seen in the past. Both of these two were on downward moves on the euro, bullish moves on the dollar. All the rest of these, were peaks on around the 10 to 15% mark, were peaks on bullish dollar moves. So that kind of gives us an idea of how much more bullish we can expect this to be over the next so many weeks. If you take a look at when this dollar really started to make its move, and let's go back to a daily chart, when it really started to make its move here, right at May expiration, and May options expiration for the U.S. markets, May 15th here. From then on, if you take a look at a sector comparison chart, from May 15th on, that was the initial surge of the real kind of trash sectors. You can see energy went up, industrials, financials, even real estate. They all just rallied sharply, and there's materials. That was kind of the initial surge here. Small caps outpaced all the way up to that June 8th high point. Then they kind of pulled back, but the dollar still remained strong, and because of that, industrials, financials kind of gave back, lagged behind because yields are not going up. Energy has its own issues, right? It really started to lag behind. It's starting to regain some strength. You can see utilities and staples and healthcare all lagging behind as safety trades. But you also see that you have industrials and materials, and those are the two strongest sectors from that time frame. Those are dollar sensitive areas, and they're doing very, very well. And if the dollar continues to go to be strong, then you can expect that they'll continue to be very, very well. And if you take a look again, just over the last, let's say 2 years, not 5 years, but let's go last 2 years, they've been really strugglers, especially industrials and materials. They've been strugglers, and energy, of course, too. So you can see how they've got, once these QQQ type stocks kind of finish their run and slow down, there's a lot of room for these dollar sensitive areas to catch back up to these before this long-term bullish run is going to be over. Who knows when, into next year, if not beginning of 2022. So for our trade idea of the day, let's take a look at Medtronic. So Medtronic had a nice little bullish move of its own in this kind of this med tech area that's been lagging behind. It had a little bit of a breakout today. This intermediate line looking like it was going to roll over right here and come back down below a falling market sentiment, after this kind of sideways action. Well, instead of breaking down and staying down below this point of control, staying below the point of control and working towards the bottom end, it actually broke out to the upside and broke above the point of control and did it, with a pretty decent move with 3 green arrows. You can see we have 3 green arrows. The MACD's turning back up above average volume on today's move. If you take a look at the RSI, it's crossed up above 60. If you take a look at the DMI, it crossed the positive index, crossed back above 30. The negative index is still way low. The ADX hasn't crossed above 20 yet, so it's still got a run. If it's going to make a bullish run, it's still got that bullish run that left to do. And then if you take a look at the stochastics, we are well up in the upper half, way up here in the upper half of the 4-week range. The average is climbing up higher. So a lot of good opportunity. In fact, we're still in a death cross environment on this stock. So it still has a run, move to get above 100 and keep on going. So it's got a good opportunity here. So let's take a look at a trade on this. Let's take a look at selling the 105 call option and then buying the 100 call option. So what that does for us is it sets us up here. Let me get rid of this one here. It sets us up for a trade where, at worst case scenario, I'm risking $2 to make 3 on the worst case scenario, so 1.5 to 1. But more than likely, considering how, if we were to break back down here, it's going to be very easy to keep my risk to half of what I position size for. And we do have earnings coming up, so I haven't position size a whole lot anyway. But if I'm risking less than $300 to make 900, then it's a 3-to-1 reward to risk with a pretty high probability, considering how where the max gain is well within the 1 standard deviation and below where the next big layer of resistance is around 108 and up to 110. So we don't have to cross through that resistance. We can just get up to it and stay there and get a pretty decent 3-to-1 reward to risk ratio here. All right, and that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website at Market Scholars. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content, and join our community at marketscholars.com as well as the Facebook group that we created. Market Outlook Facebook group. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.